All right, we've got week 11 in the books. I want to show you my portfolio if it's still alive. It has lost a lot of money, and Tesla is the biggest factor. Let's take a look at the details, kind of the moves that I made this week. Let's get into it. There's three things I want to go over here: the Tesla stock, my futures trading, and also I've delved into some strangles as well. So you can see here with Tesla, I've got two puts that I'm selling, and I've got a spread over here as well, and I'm in the money on both. The put that I'm selling, it's a 180 put and a 175 put. The price has gone down below there, so the price is in between my spread. And I sold these puts whenever the price of Tesla was around $200. So I really needed to get back up to $200 in order for me to see my profits. And I'm looking to take profit at 50%. Now Tesla is a stock that I believe in. I believe it's significantly underpriced, and that there is a lot of potential for the upside for this stock, and I'm holding on to it. I'm just going to keep rolling those puts. I had some positions down close to 21 days, so I rolled them out to around 45 days, and that's what I'm going to keep doing until I get the price up. I think we're going to start seeing next week that the price is going to start going up, and then we're going to be anticipating earnings, and earnings expectations are pretty low. Not sure what to expect out of the stock during earnings, but I think that'll be a catalyst for the future, and that we'll see a price recovery around earnings. So that's my play. We'll see what happens with Tesla. I'm also coming out with a video this weekend, what I think about the stock and the price movement, more of a technical analysis. So look forward to that video this weekend. So you can see here this list I've got of active positions. It's pretty well all futures contracts. I've got bonds, Forex, more bonds, the micro S&P 500, natural gas. I've got the Russell 2000. The only stock that I'm really holding is Tesla, and then we have the ES here, which is the E-mini S&P 500, and then I'm also doing copper. So I want to go over copper specifically because I made some big moves on that one, and I ended up backstepping off copper. So from what I understand with copper is that the supply is starting to dwindle, and there's a rally in the price, and that causes the implied volatility to go up. So when volatility goes up, that also changes your P&L, especially on strangles, and that's something that I learned, and I'll come out with a video here potentially this coming week on the strangles and how the implied volatility affects the price. Yesterday, whenever I looked at this, my theoretical curve here, which is what it's theorizing the current price, it was bulging green above this. And it's because I opened my position at a high volatility, and then as volatility went down, my count was going up because the implied volatility was going down, the expected move was going down, and I was green. But this morning when I woke up, I was in the red. And the reason why is because volatility went up past my price, and I'm in the red. So you can see here, it looks like I'm in the red. But whenever you actually go to expiration, if you look at your expiration zone, you can see that by expiration, I'm going to be still in the green right here. So in the short term right here, if I was to sell, I would be in the red because the implied volatility is up, and that causes the option prices in general to go up. And for me as an option seller, I want those prices to go down. So whenever I am selling options at a high volatility, I want that volatility to go down over time. What happened here with copper is that the volatility went up. So one thing I did with copper was I got excited. So I sold a call and a put here at 384 and 435. And in one day I was up like $500. And then I was thinking, well, I need to add another position. You know, I'm only using like $3,000 of buying power. I can add another 3,000, put in that position and start making more money. So I doubled down on it and sold two more positions. Well, I woke up this morning and all my gain on that went to pretty much zero. So I held the positions, and then it started going against me, and I was in the red. Let's see how much it was here. All right, so whenever I closed my position, I was actually down $262.50. So I decided, you know what, I'm not taking any more chances. I'm in too heavy on this position. I'm going to go ahead and get out. And so I closed this position and left my original position on. So we can see here that even though my theoretical price is red, I'm still within the bounds of a successful trade. So my plan is to copy what TastyTrade does and to adjust the non-contested side whenever it's time to make an adjustment. So if the price ends up going up higher, closer to 427, and it keeps rallying, then what I'm going to do on this put side is start adjusting my put and bringing it up closer and closer and collecting premium along the way. And then whenever the price changes back around, then I'm going to be adjusting the call side. And I'm making the adjustments based on the delta. And then so whenever I end up meeting in the middle of the current price, that's my time to buy the guts and sell the wings. So I'm going to buy the position back and then sell wings, basically reset my position. And so I'm not exactly sure how to do that. I haven't been in that situation yet, but I'm going to be learning that, see what I need to do to be able to make that adjustment and make those moves to be more active in my positions and managing early. So that's my game plan with the strangles. Going to kind of get an understanding of what I need to do, make my adjustments, and how much money I can make on these strangles. But the benefit to these strangles is that doesn't matter what the market does. I'm going to make money either way, making these adjustments. We could have a correction, we could have a market crash. That doesn't matter because I'll be able to do the same whether the stock goes up or down. Another thing I want to show you is what I'm doing with the E-mini S&P 500. So this is something that I'm copying from my dad. He's doing the same thing with the S&P 500 SPX. I'm doing it with the E-mini S&P 500 futures. For one, I like futures and it's going to require less money. Now I have less of a return, but I'm not using my entire portfolio on this one strategy. So I call it the 30-20-10 strategy. It's something that my dad does, and he got the idea kind of from Karen Supertrader, which if you don't know her, you can Google her and find out her story. But she is known as the Lamb of Wall Street. What the plan is that you do a 30-day expiration every day. So you're adding a position. You're going to be selling a put every day on the S&P 500. You're looking for a 20 delta. So let's take a look at that. Let's just play a trade. So I've got for me, I'm doing the futures. We have the E-mini S&P 500 here. I'm looking for 30 days out. You can see my active positions right now. So let's just say we'd go out to the next day to 33 days. Then we would go to 20 delta up here. So I've got my delta symbol here. I'm looking for around 20. I would sell the put. And then what I'm doing is I'm doing a 10 spread. So I'm going to buy this back and do a $10 spread here. I'll be collecting a max profit of $70. That'll end up being 35. And I'm using 165 in buying power effect. So I'll keep placing these trades every day until I get to 30 days, and then I'll let it expire. Now, with it being a future and not the SPX, I may have to go ahead and close the position at 0 days. We'll see what happens. But the plan is for me to be able to let it expire, and then I'll repeat the process. And then whenever I make enough money for a new position, then I'll add 2 contracts. Then I'll add 3 contracts, 4 contracts. So I'll just keep doing that through every 30 days. And as that grows, I'll be adding on more contracts. All right, let's take a look at the week 11 recap. So we're ending the week with a net liquidation of $15,272. Total premium collected this week was $2,900 with a total return of a negative 6% on the week. Year to date, that's a net liquidation of negative $751 on the year. I'm going back to the beginning of the year right now. I'm back in like week 1 or 2 in my return right now. I was in the red at the beginning of the year, and now I'm right back where I was. But the difference here is that my premium collected this week is very large. So you can see here that even though it's not a realized premium gain, these are the positions that I've opened in the week. And so I've got a lot of big positions on right now, and I'm looking to collect a 50% return. So it's not going to be as big as that, but you can just see kind of the activity that I've put on in my options trading, and it's very big. So my trades as they're working out with the strangles that I'm doing, the different positions that I'm working on, it is going to be a big impact as long as I can manage them well. So we'll see what happens next week. I'll give you an update at the end of the week on how my portfolio is doing and update you with as many videos as I can along the way. I think I'm at a point where I'm starting to learn a lot of things in a very short period of time. What I want to do is be able to upload those and just kind of fill you in on what I've learned. And it might be on a daily basis. We'll just see how it goes. But I want to keep you informed on the things that I'm learning. We don't have a gap between what I've learned and then what I'm sharing with you. So I'll keep you in the loop as often as I can. We'll see you in the next video.